Welcome to episode number 23 of the Zach Faust Show. Today we are bringing on economic pundit analysis, Mr. Robert, for the second time from his channel, Infonomics. Robert, how you doing, friend?
Good. How are you?
If I was any better, I'd be twins, brother. Life's good. So you are a absolute monster on TikTok, or I'm sorry, YouTube, and creating consistent content around updates in the economy, and you speak to the layman. You speak in a way where you're taking the complex and you're weeding it down to the simple. Here's exactly what's happening. You put politics to the side, you put emotion to the side. Let me just ask you, what got you into that? Would you always just want to be a YouTuber?
No, I was actually out of like the internet really from call it 2010, 2009, 2010, all the way up until just a couple of years ago. Like
Whoa.
I would hear people oh, they're making a living making videos, or oh, they're making a living on Instagram or Facebook, or right. Like I knew about people making a live. I called it internet money. But I wasn't really on social media. I was kind of a little bit of a Luddite, kind of disengaging from all that. But yeah, then I got into macro, made a Twitter account mainly to follow people that I looked up to in an effort to learn. So I made that Twitter account, and yeah, it was very small, like tiny for 2 years, 3 years, really. It was like 500 followers. Then I started to participate in the spaces. From that was like a year and a half ago. From there on, it just kind of exploded. And I think I was around 18,000 on Twitter followers when I had the idea, well, like just do a YouTube, because I was putting out all these articles, again, trying my best to explain things, complicated macroeconomic phenomenon in simple English. And I was putting out these articles, and I kind of thought to myself, like, YouTube would be cool because I could kind of do like a PowerPoint. I could kind of like go through it more, engage actively, kind of. And so, yeah, I was like, F it, I'll just start a YouTube. And I did. And 5 months later, it's got 23K. So it's just
Right.
crazy. It's just wild.
And what's the goal there?
Education, mainly what exactly what you said. So I think that there's a huge, or what I've picked up on is that there's a huge appetite from normal people. They know something's broken in the economy. They know something is broken in the system, kind of writ large, and they just can't articulate it. They can't put their finger on it. They can't articulate it. They see second order effects and like signposts that are indicative of a failure of the system, or issue with the economy. And they might be able to identify that, right? Home prices are kind of one of the obvious ones. Oh my God, it's the average home here in LA is like $1 million, so you might be able to identify that, but like to really articulate the people know something is deeply, deeply wrong. And I think, education on how the economy works, how the financial system works, how markets work, how global trade and global capital flows work. I think all these things are really important because, yeah, there's some pretty deep structural issues going back to really the early mid 80s, but really kind of taking off in the 90s. There's some very large structural issues that really got to be addressed if we want to have the America that I think we all want, we all know we can have, and that I would say that we all deserve.
And it sounds like you're throwing a quick jab at Reaganomics with that mid 80s comment, because that is around where that timing happened. What do you think are one of the more pertinent foundational issues in our economy today? Speaking nationally, just domestically, what are some of the biggest issues you see?
So I think that the deficit is certainly up there. We're running a 7% pro-cyclical deficit. Now, normally the
Now, when you
deficit,
say reciprocal, can you explain what that means?
yeah, so normally the deficit will increase during a recession, during an economic slowdown. You'll see that deficit start to move higher, and the reason is because you're trying to kind of artificially stimulate the economy through deficit spending, which is a net new increase in the debt. And unemployment's probably high, right? You're in the grips of the GFC. You're running this large deficit. Some of it is automatic, what they call automatic stabilizers, things like unemployment benefits, Sometimes there's going to be a jobs program or something like that. But then you also have a decrease in revenue by definition, generally during a recession. Now, on average, revenue falls about 20% for the government, and this is actually spending goes up.
During recessions falls about
Yeah,
20%? Okay.
yeah.
And that
So
revenue is strictly consumer spend, tax revenue? Where is
tax
that money
revenue.
leaving?
Yeah,
Tax revenue.
mainly tax revenue, and like unfortunately, the economy has become so hyper financialized that a large part of it is capital gains tax revenue, right? Because if you're in a recession, the stock market's falling, assets are falling, so capital gains tax, which is a large marginal driver of overall revenue, that is falling. So the revenue piece is falling, and meanwhile, you have government spending going up. And so that, the difference between spending and revenue, that is the deficit that people talk about. So 7% pro-cyclical deficit, like we have unemployment at basically like all-time lows within 100 basis points of like all-time lows. Even at 4.3, which is where we are today, that's still very, very low. When you zoom out and look at the past 75 years, that is still very low. We have inflation that is kind of structural and embedded now. And running such a large deficit is inflationary, especially when it's being financed by Treasury bills. We saw under the last administration a shift away from kind of spreading out your debt into let's just issue a ton of Treasury bills. And so, yeah,
Which for people listening, that's the difference between short and long-term debt. Those T-bills being shorter debt, usually under a year, right? 2 years?
yeah, yep. Yeah. So shorter debt, shorter duration debt is called Treasury bills. Bonds are the longer duration. And Treasury bills, short-term debt, is much more cash-like. It is basically when you buy a 1-month Treasury bill, you're basically that you are buying a dollar that gives you some interest with an expiration. And so you can think of a dollar bill, physical currency, as a zero yield, infinite duration Treasury bond. It's really what it is. If you look at Federal Reserve note, right? So notes are kind of the next duration out. But yeah, money and bonds are much more. There's much more overlap, and they have much more similarities than I think I ever knew, right, before I got into all this. And so, yeah, really understanding the bond side of it. Treasury bills being shorter duration have less what is called convexity. Convexity is a phenomenon that affects longer duration debt. And this is very evident if you look at CLT, which is an ETF that tracks the value, the underlying value of a 30-year 20 to 30-year U.S.
An
Treasury.
index around bonds?
ETF, yeah. So when you
Or
buy
yeah.
that ETF, you're basically buying a share, right, a piece of 20, 30-year bonds. So you get interest, right? There's dividends, which is the interest. But it tracks the value of the underlying bond, not the interest rate, but the actual value of the bond. And you can compare that to say an ETF that tracks the 2-year Treasury, and you can see that, for example, TLT is down, I think, like 40% over the past 4 years. A similar ETF for a shorter duration bond is going to be way less volatile because there's less of this effect called convexity. And so therefore, treasuries are the collateral for the financial system. So again, most people don't know this, but about 90% of all dollars in the system were created out of thin air by a private bank. They were loaned into existence by a private bank. Well, when the private banks are doing that private credit creation, printing money basically by issuance of new debt, when they are doing that, the collateral for the financial system, when you're talking about the banks, is treasuries. And so if you have a less volatile treasury bill, you can more easily and readily lever that as the collateral into more new U.S. dollars, right? Dollars, because the collateral is moving around less, right? Think of a home equity line of credit if housing was moving 40% on a yearly basis, right? You wouldn't be able to get as much home equity. Your line of credit would be smaller because the volatility of the underlying asset is so significant. So, these treasury bills, and this started with Janet Yellen under the last administration, are much more similar to cash. A long-term bond at least is slightly different. It's not cash. It's not as liquid. It has more volatility. It's more of an instrument, a debt instrument or security, right? Like something that yeah, you can lever it into new US dollars, but because of the underlying volatility of it, it's not really the best collateral. So because of the volatility. So the shift into more of these short dated treasury bills is very stimulatory. It's very inflationary, because again, you can take that $100 of treasury bills and create 99.9 new dollars off of it, right? That as the collateral. Whereas if you had a bond, 30-year bond, you might only be able to create 60.
So
So
what I'm hearing you say is our issue around the deficit, 7%. I'm going to come back to that because there's a lot of common misconceptions around the deficit. Some saying we shouldn't look at it, others saying it's the most important thing in the world to look at. I'd like you to explain that. But that we're issuing short-term debt because it is less volatile, it is easier to turn around and leverage into real cash for our country, and that right now we're in a situation where 90% of our money didn't exist before private banks printed it into existence, before Federal Reserve entities started quantitative easing and holding bonds and holding securities off the market. And that deficit growth is what you're saying is basically one of the dominoes in the line of us doing that because we have treated our debts in such a way that has led to today's deficit problem?
yeah, yeah, I would say that that's fair. The deficit, right, has, again, going back to kind of what was normal, which is you run a deficit during a recession. If you look, going back to say early 2000s, the unemployment rate since 2000 has basically gone down. But if you look at the deficit, it is 6 or 7x larger, worse, despite that lower unemployment rate. Now, that's not to say the economy is great, but you do have a lower headline or U3 unemployment rate, and a deficit that's 6 or 7 times larger. And look, that deficit, there is some degree of truth to, if people are familiar with MMT, modern monetary theory. I disagree vehemently with some of the solutions or some of the implications, right, of MMT, and some of the proponents I vehemently disagree with, but they are correct in certain areas in terms of identifying phenomenon. And when they say that a public sector deficit is a private sector surplus, that is correct. That is just kind of objectively on an accounting basis correct. And look, when 90%, this is not a new phenomenon. The 90% of dollars being created by private banks, that's not a new phenomenon. That's not. This is how it has been. If you go back to the 70s, the part of the reason that we have this kind of higher rates we didn't see in 1980 or 1981 deep sharp recession is because back in the 70s and early 80s, that private sector, that private bank money printing was a much larger component. So the higher rates were more restrictive on it. Well, now you have a 7% government deficit, right? Again, on the other side of that $1.2 trillion per year in interest expense, on the other side of that 1.2 trillion per year, there is someone getting interest. So as Lynn Alden says, raising rates in a highly levered system with a large deficit, it's much more of a mixed tool in terms of battling inflation. But of course, interest expense blows out. Well, how do we pay the interest? We pay the interest by increasing the deficit. We don't make enough via tax revenue. We run a trade deficit, meaning money is not flowing in on a net basis into the country. So we must run an even larger deficit. And so this is the debt doom loop that people have worried about, where rising interest expense causes a larger deficit. Well, again, the deficit is just net new debt increase, net new supply of bonds that must be issued into the market. Again, so that the Treasury gets dollars, right? When they sell a bond, Treasury gets dollars. Then they can spend those dollars to, for example, pay the interest on bonds from before. If that sounds like a Ponzi scheme, fair characterization. But you get this larger deficit, Interest expense drives a larger deficit. Larger deficit drives more bond supply into the market. Well, if demand, called demand constant, if you increase supply of bonds that you're pushing onto the market, and the demand for those bonds is not increasing, well, you get higher rates. Well, what do higher rates mean? That means more interest expense. What does more interest expense mean? Higher deficit. So the deficit. I would say this: the absolute level of the debt, right, 37 trillion. It's not the number to focus on. I think that the deficit as a share of GDP, and of course the current account deficit, which is the other main economic account, financial account, those two numbers as a share of GDP are really, I think, the major problem. And there are second order effects, third order effects from these things, right? The current account, when you invert that, what that means, if we're running a large trade deficit of about $150 billion per month, what that means is on the other side of that, to balance that deficit, $150 billion per month must mechanically flow into US financial assets. So it's just the mirror image.
And those are real, and that's real estate, gold, crypto, bonds, stocks, anything
Yeah,
that's
not
an asset.
Yeah, it's sovereign generally, so not as much like crypto, for example, but definitely real estate. You can find, and I've done this, dug through the BEA reports on the current account, and they delineate FDI, foreign direct investment, which is one of the kind of subcategories of that capital inflows. One of the subcategories is FDI, and if people search this term, BEA FDI real estate, they should be able to pull up the report, and you can see that going back, throughout time, this has been a massive amount of hundreds of billions of dollars that have flowed into real estate here in the U.S. just mechanically
From foreign
from
investors.
foreigners
Yes.
as a result of running a large trade deficit. That you start kind of playing through the consequences of a 7% deficit or a 5% current account deficit. Look, I'll point out, I might have mentioned it the last time. The last time we had an honest to God housing bubble in 2006-07, even the economists themselves, the paper, which is very pro globalization, even they admit that part of the reason we got that housing bubble was the fact that the US was running a 5 or 6% current account deficit as a share of GDP. Because again, what that means is mechanically on the other side of that, there are these huge amounts of capital inflows into treasuries, corporate bonds, equities, and real estate. And so, that drove to some degree the housing bubble. I'll point out too, .com, right? That was an equity bubble. That was a stock market bubble. Well, if you look at the deficit, right, which is net new debt issuance, right, the amount of new debt that you are issuing, if you look at that during the mid to late 90s, we were running a surplus. Well, what that meant was that being the reserve currency, we were not creating new dollars, new interest-bearing dollars, treasuries. We were not creating a net increase in new interest-bearing dollars for the rest of the world to buy. And so what did they do? They bought equities. They bought stocks. So we got the .com bubble to some degree due to the fact that we were running a surplus, a fiscal surplus, meaning we were already the reserve currency of the world. Foreigners didn't have interest-bearing dollars to buy because we were running a surplus.
It sounds like you're one of the people who are the belief that a recession is only caused by government.
I think I would say business cycles. Like if we had a real free market, you would get recessions. The problem is we don't have a free market. The problem is we have privatized gains and socialized losses,
Amen,
and
brother.
the Fed, and the problem is
let me switch gears. Let me switch gears on you because I know you also have some graphs that you want to be able to bring up for everybody. That is your thing. If anybody is a data nerd, graph nerd, that's how I found you. The thumbnails are graph, and I'm like, ooh, graph. And you're voicing over. You're doing the same exact thing you're doing right now, where you're walking through this data with the visuals. I want to switch gears to the housing market because the bond market is so much more impacting mortgage rates than I think people realize. They don't realize the Fed rate isn't the mortgage rate. And that the other side of things is that if rates were to drop, that the housing market would just solve itself. So I want to ask you, as someone who deep dives the numbers, I focus housing. You look at everything though. What is going to be, if any, the solution for the housing market without some sort of change? Is there a free market solution? Is there a cycle we're going to hit where housing becomes affordable again? Is it just because of rates being high? What do you think the next 3, 5 years look like in the real estate market?
Yeah, so I would point again, kind of to what we were talking about with free market. I would point to the fact that the Fed owns a huge amount of mortgage-backed securities,
Trillions. Yeah.
2 trillion, I think. I'm trying to pull it up, but one way to fix this is the Fed takes those mortgage-backed security holdings to zero, and mortgage rates would skyrocket. And the only cure for high prices is high prices. And look,
I love
going
that. That's so true.
you
The
know
only
going
cure for high prices is high prices. Yep.
and going back to the that foreign demand. The key point there is like Blackstone, right? These private equity guys, they're somewhat price sensitive when it comes to the purchases, right? Large corporations, whoever it may be, people here in America purchasing homes, whether in a corporate sense, they are somewhat price sensitive. Well, those foreigners that we establish are, equates to hundreds of billions of dollars per year buying real estate as a result of running a large trade deficit. They are price insensitive. So the larger the trade deficit gets, the more price insensitive foreign buyers there will be. Again, because this is just a balance of payments thing. Now, another thing I would point out here is the average annual interest expense per year on the average home. So if on the average home, what is the average person going to pay in interest? And for those that have trading view, this is the average home price times 0.8. We're assuming a 20% down payment. And then you multiply it by the 30-year mortgage rate. So what we're looking at here is $26,000 per year on the average home in interest. Now, if you look, for example, here in this period of time, kind of the mid 2010s, this number was like 10,000. So we have 2.5x, almost 3x the amount of interest that you will pay on the average home. So this is just here in red, by the way, is the 30-year mortgage rate, and we were in a secular bull market when it came to bonds. Meaning lower rates as they're inverse to each other. We were in a secular bull market for bonds. We clearly broke out of this downtrend here in 2022, and we are in this kind of higher rate environment. This is going to affect dramatically the average person like myself that would like to buy a home. The interest expense is just crushing. And of course, to get long rates down, you had mentioned the Fed. To get long rates down is a totally different thing than, we'll just cut the federal funds rate. So here is the yield curve or parts of it, good representation kind of across short to all the way out to the 30-year. And the white line is the federal funds rate. And what I always point out in my videos is you generally, when you look at Fed, there are cutting cycles and hiking cycles. There are periods of time where they are kind of over time, they are cutting, and we are clearly in a cutting cycle. This began right before the last election, September 2024. Since that date, which was September 17th, the day before the Fed meeting, since that date, the 30-year yield they have cut 100 basis points. They have reduced the overnight interest rate by 100 basis points. And despite that, the 30-year Treasury yield is up by 80 basis points.
And I'd like to, I just want to add one thing to see if I'm seeing this correctly, because for people watching and seeing all these rainbows of colors, the dark purple is the 30-year Treasury note. The white line is the Fed rate. And what you're saying is, and this is absolutely true, that when the Fed made their 3 cuts at the end of last year, the 30-year rate actually went up. The 30-year bond went up. But one thing I'm also seeing in this that might bleed a little bit into what's going on to today is it does seem like there was a steep drop-off in anticipation for that first cut. It seems like there was a lot of pricing in that first cut right before it happened. And then it started going up. And as we see today, we see that kind of similar action of pricing in a potential cut for September. Follow up, do you think that the cut of the Fed rate, whether it's a quarter, a half, do you think it lowers the 30-year Fed or the 30-year bond rate?
Well, from here, probably not much. Like you said, markets, especially the bond market, are forward-looking instruments, especially when you're talking about duration. When you're talking about the 10-year, the 30-year especially, it is looking very far into the future. Because again, remember, if you're buying a 30-year bond, you have to be confident that over the next 30 years, inflation will never be above 4.7%. You also have to try to forecast nominal growth because, you could put if you believe, for example, just using simple math, that the economy is going to grow at 20% per year, or 15% per year. Well, you wouldn't want to buy a 30-year treasury at 4.7. If you believe growth is going to be just explosive for the next 30 years, you would want to buy probably equities. And you would look at, earnings growth and certain metrics
Housing and
with
stocks,
equities.
things like that.
But yeah, these markets are forward-looking instruments, and you are correct. There was a huge amount of cuts that were being priced in during 2024 and to some degree 2023. We can see, for example, in 2023, the 30-year Treasury went from 5 all the way down to basically 4, which is where the 10-year is right now. And so that was pricing in a very significant negative growth impulse. And a huge amount of Federal Reserve rate cuts. And so, yes, there was certainly a pricing out of more rate cuts that occurred. But yeah, I mean, you can see pretty clearly, like the day before the Fed started to cut, that was the bottom in the 30-year yield. And remember, for those, the value of the bond, think TLT, tracking the actual value of the bond itself. The value of the bond is inverse to the yield. So that was the top in terms of the value of the bond. As soon as from the time that they started to cut rates, the value of the bond has gone down. And this is why it's called a bear steepener, is because it's bearish for bonds. Now, a bear steepener is very abnormal. And I would argue that over the past week, it's no longer so much a bear steepener, looking at it in terms of a cutting cycle, because you have short-term rates in the belly of the curve. Like, for example, look at the 5-year. The 5-year from when the Fed started to cut, I mean, technically this would still be a bear steepener. But if you look at the 2-year or the 1-year, those are below when the Fed started to cut. So it's not really a bear steepener. But again, what that indicates is that the bond market is worried about the fiscal health of the U.S. They're worried about inflation. The fact that the 30-year yield, and all around the world, this is not just a U.S. story, but all around the world, 30-year yields are going up and to the right. This is sovereign debt is an issue not just for the U.S. No one wants these long-term debt instruments, and this applies to Canada, France, UK, I mean, all over the world, Japan.
Japan's
So yeah,
struggling. I've seen Japan struggling.
yeah, look, I think that certainly over the past couple days, we've seen a pretty notable decline in the 30-year Treasury yield. I saw a headline today. Mortgage applications are starting to pick up. From here, does the 30-year decline much more? Maybe 4.5 at the most, I could see, but probably not much more than that. I mean, nominal growth, which is
for those listening, that would get mortgage rates to about a 5.
So yeah, I maybe there's some more downside. I mean, I think it really depends on the labor market. There is this, significant pronounced fear that the U.S. kind of in aggregate is much weaker than people had suspected.
Let me ask you about
certainly
that.
the labor market.
Let me ask you about that on the labor market side, because we can speculate what's going to happen with the future of bonds. Your thoughts and mine align in, if we were to drop the Fed rate, we're not going to see as aggressive of movement in the 30-year mortgage rate as we would like. And that if we are too aggressive, we didn't touch on this, but if we are too aggressive and push to the 100, 200, 300 basis point cuts that the administration has called for, I mean, we're talking about it could absolutely actually spike and have the opposite effect, no?
Exactly. Yeah. So it's a balancing act. Here we're going to look at global 30-year rates just for an illustration of this global death march, duration death march that
Global death march.
sovereign zero hedge came up with that. That is not original.
That's funny.
And we can see all over the world a rate, long-term rates duration is up and to the right. Or remember, put another way, the value of the bond is doing that. Um, and so, yeah, this is an issue where the fiscal, the profligate spending and the interest expense, which is starting to blow out, you know, if you look at all of our marketable debt, the average interest rate is 3.3%. So what that essentially means is unless the Fed can get the short-term rate down to 3.3, which would be almost basically 100 basis points of cuts, unless they're able to do that, our interest expense is only going up because as we refinance and roll all this debt, the
Correct.
average.
Which, back to your point earlier, wasn't a problem in 79 to 81 because we didn't have nearly the government debt that was being paid out today that we did then. It was more of a private, personal decision on our market to raise rates to keep the private lending market from pushing on. And today we're kind of fighting two different battles at the same time because you have the private market's problems as well as our own nation's economy, correct?
Yeah, so like US government debt as a share of GDP was much lower back in the 80s than it is now. This is using, I hate when it does this, not economics, government debt. Yeah, so back in the 80s, as we can see, public debt to GDP, government debt to GDP was quite low. This is the last time that we had that, you know, Paul Volcker raising rates. We ended up he ended up having to reverse course. This is the only other time the yield curve has steepened in a bear steepener that we were describing here, where the Fed starts to cut rates and yields go up. The only other time that that has happened in the past 70 years was back in 1980. And it forced Paul Volcker at the time, who was the Fed chair, it forced him to basically, reverse course and start raising rates again.
Because they
And
had started to cut exiting the 70s. The bond market didn't basically respond properly, and so they had to raise them back up. What did it end up getting to, like 19%?
yeah, so the federal funds rate got to 19%. So here I will put on recession so we can see the effect of the 81 recession. By the way, this large one, long duration. This was the steepest recession in post World War II history at the time. And so, yeah, you can see here that he cut rates, and this was in response to the 1980 or 79 recession. He cut rates, but inflation was structural. There were supply issues with oil. Inflation, they ended up having to raise rates again. When he started to cut here, I will put the 10-year on because that was the only duration they had back then. You can see that when he started to cut rates here, starting from December 1980, the 10-year yield went up. And in fact, even we're looking at the 3-month, even the 3-month started kind of to some degree went up. A short duration. Now this might have been due to, yeah, he started to raise rates there. But yeah, yields started to climb. And what that was indicating is the Fed, you're wrong. You shouldn't be cutting rates. Inflation is a bigger problem than you realize. Now, Paul Volcker was able to recognize that and was willing to reverse course and take the federal funds rate back up to about 19%. And ended up causing the 1981 recession, where of course yields eventually started to fall. So yeah, I don't think we're going back to that because you can't. Going back to what we were talking about before, debt to GDP back here was like 30%. We're 4x that at 120%. So the dynamics are a lot different when you're talking about an economy with debt to GDP of 30%. The dynamics are a lot different than when it's 120%, of course. And of course, there's the pro-cyclical deficit that we were talking about earlier, that kind of government side that is running this utterly insane World War II level, right? Like World War, global conflict level recession Like I get times are not great. I'm the first person to talk about that, but like they're not that bad for 7% deficit. And that's coming in with a very large current account deficit, which is basically the trade deficit.
And I want to make sure people got this graph when you put it up there, because that last one, the mortgage rates, because this is so huge. $26,000 if you buy a house today, get a mortgage today, and you get the average 30-year rate, what this chart is showing you is you will be paying $26,670 a year toward nothing. It's not going toward anything. And there's that's more than like what some teachers make. That's more than what some people are actually making. And it is just getting siphoned away into the system of the banking world because of rates, because of high prices. And that number, like you said, used to be closer to 9, 10, 13,000. And when I look at this graph, it looks reasonably flat from the 79 on. It doesn't really look like it increases too much. You can see
and that's despite home prices going up during that period of time, right?
Yeah, you can almost see when rates got really easy after 2010, where home prices were going up, but rates had gone down a significant amount. And now we have both of the opposites, home prices going up with interest rates going up. So with this graph right here, for anybody listening, how does this turn back around? How do home prices or the cost of owning a home per month by a mortgage shift?
So I think that really the only way that you get long-term rates meaningfully down is QE, yield curve control.
That was going to be my follow-up question. You nailed
something
it.
like that. Yeah, because
so you're of the belief, and I'm of a similar belief, that like 2008, 9, and 10, the only way that we were able to suppress the bond market and suppress rates down was via purchasing of bonds from QE. So you think that we're walking into a world where we're going to have to consider the same options?
Yeah, I mean, there is an alternative, which is they let a sharp, prolonged, deflationary recession. Now, what happens in that? You go into an imminent death spiral, debt doom loop. Can't be allowed. You can't have deflation when debt to GDP is 125%. When you live in a debt-based monetary system, which we were talking about earlier, 90% of dollars are created by private banks by net debt issuance, right? So money printing could be also said the same way as debt increase. Our money is debt, or put another way, debt is money. Well, in a debt-based monetary system where everything is so highly levered, you can't have deflation, or you can't have the value of the collateral, which is being used to lever it up, right? That whether it's a home, whether it's stocks, whether it's bonds, you can't have that underlying collateral start to plummet in value because so many people have levered off of the underlying collateral. It would be catastrophic. Now, that would be the free market, at play. And say
which many argue there would have been a deeper, darker recession post 08, though not as bad as the one you're mentioning, because we stepped in and messed with the free market. Do you believe that every year past that, every QE past that, we're just basically blowing up the ball that's about to get thrown at our House of Cards tower? Like it's just going to get worse and worse the longer we wait for that to happen?
Yeah. So that made me think of the debt held by Federal Reserve banks as a share of total government debt.
Glad your brain thought of that. I don't know how that happened, but
so here we see this is debt held by Federal Reserve banks as a share of total debt. And this looks very similar to the Fed's balance sheet, where it's kind of up and to the right, with higher lows, right? I'll put on the Fed balance sheet so that we can see that as well. This is in red. This is the Fed balance sheet. But back here during this period of time in kind of the late 80s, early 90s, for example, debt held by Federal Reserve was about 7% of total U.S. government debt. That number now is 12%. And as you can see, there's an uptrend, right? This will increase during a recession, during QE and all that. They'll try to quantitatively tighten. And you see that with the balance sheet as well. They will try this QT, but as we can see, right, the Fed balance sheet went up to $9 trillion in at the peak. from a level of about 3.7 trillion. So we went from 3.7 to 9, and they brought it down to 6.6 trillion. Well, 6.6 trillion is still double what it was going into the crisis. So, and you can see that uptrend, right? If you're a trader, that this is a textbook uptrend with higher lows. So yeah, and every subsequent crisis, the intervention necessary is becoming larger and larger. And so, during COVID, taking the balance sheet from 3.7 to 9 trillion. I mean, that's like $5.8 trillion and remember, on the other side of the assets, right? The red line is showing the assets that the Fed owns, the value. On the way that they bought those assets was by printing money out of thin air. So when people talk about QE, there's this whole debate, is QE money printing or not? Well, to some degree, yeah, it is. Like, yeah, it's an asset swap because the Fed is printing these bank reserves, which are half of the monetary base. And then they're printing it out of thin air using those bank reserves to then buy treasuries or mortgage-backed securities. And so, yeah, like at the root of it, it is money printing. The bank reserves, which are used to purchase the mortgage-backed securities or the treasuries, those bank reserves are printed out of thin air, created out of nothing by the Fed. So it's not, in my opinion, it's not really incorrect to call it money printing. It is also an asset swap where they're printing money to buy debt instruments. But yeah, as you can see, every subsequent crisis, I'll throw on recessions, so you can see that. Oops, not Uber. I've typed NBER like thousands of times, and my computer still thinks I'm trying to say Uber. So you can see.
I was about to ask if Uber has stat lines that we can analyze.
Yeah, I mean, you could see the difference between, say, the response to 2008, right, which was dramatic, no doubt. And to answer your question, it would have been worse if they had not stepped in. We can see the Fed balance sheet went from about 900 billion all the way up to a peak after QE3 of 4.5 trillion. It was much more prolonged. It was much more, prolonged over a period of time than, say, 2020, where it just went vertical. So yeah, I think that, if there is another crisis, which ultimately it's just kind of a question of when there is a next crisis, they will, especially with debt to GDP at 120% and so much leverage in the system, the response will be quicker than, say, 2008. It'll be more, it'll look more like this response where the balance sheet just goes up by $4 trillion overnight. It'll be a shorter duration, it'll be more rapid, and it'll be more pronounced in terms of level.
Man.
But that's how you get 30-year rates down.
By infiltrating the free market.
I mean, the only other option that they really have, there are, believe it or not, firms like pension funds, for example, insurance funds, they buy long dated debt. And if there are, so there are buyers of these horrible, 30-year treasuries. There are people that buy it. If you reduce the amount of supply of 30-year bonds, so it used to be, 60 billion, you take it down to 10 billion, right? You artificially constrain the amount of supply. Well, we established there's kind of this demand from pension funds and insurance funds, right? Kind of a stable demand for these long dated debt instruments. If you decrease the supply, which is up to the Treasury, they can decide. They have been doing this. You decrease that supply, you basically kind of make the bond artificially scarce.
That makes sense.
And so therefore the value of the bond goes up.
So then where you to go back to one thing you said it's not a matter of if but when. So where, in your opinion, I'm gonna allow you to put your free from any clipping to tell me your prediction of where does it crack? Do we see a bank failure like we saw in the 30s and 2006 and 7? Do we see the bond market crack? Does housing crash? Where do you see the most, I guess, vulnerable area of our economy from all the different movements that are happening between the bond market, the SOFR lines and the Fed rate. And there's just so much to conglomerate. You seem to be the one who's always soaking it in. Where do you see the crack happen?
So there are a number of risks. I think some people sometimes leave negative comments because I try to inform and educate people on risks. I don't say it's going to happen, but here's how the system works. Here is a risk to be aware of, so you don't lose all your money. And so that being said, it is not a call that this will happen.
Yes, this is not investment advice. Do not buy, sell, or invest on anything we're saying.
Yeah. So here we're looking at overnight dollar markets. When you talk about the Fed rate and how they don't control the long end, the Fed rate is an overnight interest rate. So normal people don't borrow money on an overnight basis and pay 4.33. This is a bank, hedge fund, money market fund. This is a financial. This is the plumbing of the financial system. Is the SOFR market, the overnight dollar loan market. And if you look at SOFR volume, this tells you the amount that is financed every day in these overnight, very, very short-term loan, dollar loan markets. Yesterday, $2.86 trillion was financed just yesterday alone on an overnight basis. So these are huge. This is a huge, most people don't know have never heard any of this, but this is the plumbing of the financial system. And what we're looking at here is how the Fed actually sets their, when people talk about the Fed rate, it's actually a window or a range. They use different tools to create a ceiling and a floor. So basically what the federal funds rate is, or what an interest rate is kind of generally, is the price of money. Now we have a bunch of unelected people determining the most important price in the world, which is the price of money. That is what an interest rate is. And the way that they do that is you can think of the discount window rate as no matter how scarce dollars become, we will always provide them to you at the discount window rate. So it's setting a ceiling in terms of the interest rate. The reverse repo is the exact opposite. No matter how scarce, no matter how abundant, overabundant maybe, dollars become, we will always guarantee that we will buy them at this interest rate. So they're setting a floor in the price of money. Now, it's not always successful. If we look back to, say, 21, 22, we can see the yellow line, which is the free market interest rate called SOFR, or secured overnight funding rate. If we look at the SOFR rate, it was dipping below the federal funds rate, which is in white. And this was back when we were printing trillions of dollars and money was flowing, stimmy checks.
Abundant.
There was an overabundance of dollars. They were not successful in keeping a floor in the price of a dollar. And as we could see here, for example, on June 14th of 2022, the free market was determining the price of a dollar on an overnight basis to be 0.7% interest. Well, the Fed was trying to make it 0.83%, right? So they're not always successful in setting a range and controlling the price of money, the actual price of money, which is SOFR, which reflects, again, kind of supply and demand of dollars. So I want to call this the major risk, but it is something that has been popping up recently as a newer thing that I've kind of been watching pretty closely, which is what has been happening is you're getting conditions that are eerily similar to what was called the repo rate crisis. This was in 2019. Most people have never heard of this, but in September of 2019, there was this repo rate crisis, this overnight dollar funding market crisis, where dollars became so scarce. There were so few dollars in the system. Everyone wanted dollars, right? So imagine you're the only person with $100 and you have 1,000 people coming at you. I need your $100. Well, you can charge a very high interest rate. And sure enough, that is exactly what happened. The repo rate spiked. It was actually even worse than what this chart shows. But even using this, the Fed wanted the overnight interest rate to be 2.1. Well, the free market, based on supply and demand of dollars, was saying, no. There are so few dollars in the system that the cost of money is actually 5.2%. Now,
What was the
again,
fix for that? Seems like it got fixed very fast.
so yeah, so the fix for this is an injection of dollars, money printing. And of course, many people will probably remember what happened just a couple months later. We ended up getting, uh, the perfect reason to print a huge amount of money. Now, I'm not saying it's connected. A lot of people have pointed to that coincidence, that you just so happen to get the very thing that would fix. You're right. You needed what the SOFR rate spike indicated is there were so few dollars. Everyone needed dollars, but there were so few dollars. The interest rate was out of control. It was actually, again, like even where it was like double this actually on an intraday basis. It went to 9%. So the Fed was trying to set the price of a dollar at 2.1, but the free market was saying, no, there are so few dollars in the system. The price of a dollar is 9.1%. So that's, that would be equivalent to tomorrow we wake up and the overnight dollar is trading at like 12%.
Jeez.
Or 11%. So it's a radical thing. It would have brought down the financial system if they had not intervened and printed a bunch of money. And what we're seeing today is nowhere near the same scale as that repo rate crisis, but we are seeing going back to Tuesday of last week. The white line, by the way, indicates the federal funds rate of 4.33. And if you go back to, or really even before that, if you go back to last week, you can see that SOFR has been moving above the federal funds rate. Now, when it does this by 2 or 3 basis points, really not a big deal. And you can see that there's volatility here, and it does this from time to time. But then it corrects, and you don't see it kind of hang out 5, 6, 7 basis points. It was as high as 9 basis points above the federal funds rate here on Friday. So generally, you don't see that. And the other thing is that you don't generally see that when it's not month end or quarter end. I don't have those. Man, I thought I had those saved here. You do see SOFR spike above Fed funds at month end or at quarter end. And all of these other spikes that people are probably looking at, their eyes are going, well, it did it here and here and here. Like literally every single one of them was either quarter end or month end. This started occurring, September 7th, September 6th.
Understood.
So
that's interesting. Well, that gets me into the last question I wanted to leave us off with, because next week we have the next federal funds meeting. We're going to go live here on this channel, watching Federal Reserve Chair Jerome Powell give his sentiment on the market, based off of Jackson Hole, based off of job loss reports that we've had. One recently revised to say that we've lost about 911,000 jobs that we thought we had gained. There's a strong leaning, I think it's 92%, that there will be a cut. I think it's well over 60%. They think it's going to be a 50 basis point cut. I don't want you to give a rate prediction. I think both of us agree it could be one of the two. We don't really know. But I think it's interesting around what bonds will do in reaction. And I also want to ask a core question of you that, as a person who's monitoring the numbers and monitoring the economy may make it a little uncomfortable, but I also have heard you address it, so I'm comfortable asking you about it. How accurate, how real time, and how much of a mirror reflection of our economy do you view the current CPI and unemployment data numbers that we have? Do you view them as accurate reflectors of the actual health of the economy? And I'll say this before and let you go on, but many people seeing these job loss reports that are revising all the way back to even 2023 and 2024 are showing no strength in the job market, no growth, especially in the job market. We're seeing part-time seasonal work fall off. We're seeing the jobless rate go up. We're seeing people fall into the non-participation category because they've been unemployed for more than 4 weeks and looking. And we know things like if they take 1 hour of DoorDash to supplement their now lack of a job, they're no longer unemployed, right? So there's just all this weirdness. You look at the CPI index, and a third of it's weighted towards shelter, and they don't get shelter from Zillow, Redfin, or the MLS. They get it from calling boomers and asking them how much they can rent it for. So for me, I lean definitely on one side or the other, but I'm curious, as someone who's walking through the numbers on such a consistent basis, do you think we're looking at the right numbers to make these big decisions?
No. And I want to very quickly say that when it comes to this Fed meeting, I think that a dollar liquidity or financial plumbing issue is much more likely to get a 50 basis point cut, and maybe even, I know this is radical, I'm not expecting it, but it's possible, the likelihood is going up, of QE. And the reason is that the RRP, the reverse repo facility, think of this as sterilized excess cash that we printed way too much cash. This is a bucket of that cash. That bucket's empty. It's basically empty. So there is no excess cash.
If 17 billion's empty, they can just give me one of them.
Yeah, I know. Okay. Yeah, it's a rounding error when you're talking about 2.8 trillion finance.
Yeah, that's crazy, isn't it?
So what that means is that the Treasury is trying to rebuild their checking account, and it's called the TGA, and they still have $200 billion they have to remove from the financial system to put in their checking account to get back to where they want to be comfortable, comfortable buffer. Well, because it cannot come from the reverse repo facility, it has to come from bank reserves. And this is at a time where bank reserves have been declining due to the Fed engaged in quantitative tightening. So
that's the red line you're showing.
The red line is the Fed balance sheet, purple is reverse repo, and white is half of the monetary base called bank reserves. These are what the Fed prints when they do QE. And so you're going to be taking reserve balances down to levels that I will point out as a share of M2. If you look at bank reserves as a share of the overall money supply, you're going to be, because you're decreasing to rebuild the TGA, you're taking money from bank reserves. That bank reserve number will decline. And as it declines, we know M2 is going up. This ratio is going to go down. The bank reserves as a share of M2. Oh, excuse me, I did the wrong one.
Back to what you just said about the conspiracy of, that's quite convenient. I mean, I can look right there, July 2020. It looks like all three of those accounts are basically emptied out right before they have the opportunity to print.
Yeah, so
I'm not viewing that wrong.
When the regional banks failed, 3 of the 4 largest bank failures in U.S. history, when that happened, reverse repo had $2 trillion in it. Bank reserves were falling as a share of the overall money supply. The regional bank, so we can see that here, reserve balances, bank reserves, as a share of M2 reached 13%. And about 2 weeks later, you had the regional banks fail. Now, it's not necessarily a 100% causal relationship. I do find it interesting that there was, significant tightening of liquidity conditions. And again, that 13% reading, you can see the Fed balance sheet go up. Well, that was when the regional banks failed right here, when the balance sheet started to pop up again. That was the BTFP, or the Bank Term Funding Program. What they are doing with the TGA rebuild, if you take another 200, I did the math. If you take another $200 billion out of bank reserves, as M2 continues to increase, this ratio will reach 13% again. And so, that would 2 weeks later, the regional banks failed. And whether that's just a coincidence or not, I'm not sure. But then you look at this, which is the overnight SOFR markets, indicating the same thing, which is problems with dollar liquidity. I think that if these don't improve up until the next Fed meeting, you could see 50 basis point cut and maybe even some degree of balance sheet easing. Because
if he uses the easing word, the world's going to light on fire.
I would expect, unless it gets really bad, I would expect him to guide maybe the next meeting, right? It would have to get really bad to actually announce easing.
Yeah.
But yeah, that's kind of how I see the Fed. I mean,
so I'm sorry. Go ahead.
Yeah, I think that they gave it a valiant effort. They printed, the balance sheet went from 3.8 trillion all the way up to 9 trillion. They tried to reduce their balance sheet. It's getting to a kind of sketchy point. There is something called the lowest comfortable level of reserves, which is a fancy way of saying how low can bank reserves get before it causes problems. And the cool thing is we have thousands of PhDs at the Fed. If they don't know what that level even is. They have estimates, and the estimates vary. But yeah, so I think that, like, the liquidity condition thing, when you have the overnight SOFR markets pointing to liquidity stress, when you have kind of the historical analog. When you look at bank reserves as a share of M2 with this TGA rebuild, where it has to come out of bank reserves because RRP is done, it's empty. I think look like the risk of a liquidity strain. It doesn't have to be as bad as 2019, but the risk of something like that happening again is moving higher, right? As this SOFR rate has not corrected like it generally does, and we're not month end or quarter end. Like the two of those combined, right?
That's a big point. I never would have seen that. You're so right.
Yeah. So liquidity conditions, I would say, is the risk that I'm watching the most right now. Now, of course, look, that's not to say CRE. There are a number of issues. The overvaluation of our stock market. I mean, even more overvalued by these fundamental valuation metrics, even more overvalued than .com or even 1929, right? Like the insanity of the equity market and the valuations there, I would say, is another risk. CRE is another risk. So there's a lot of
headwinds.
There's some risk for sure.
So what I'm hearing is, to summarize this conversation, if we're looking at the future of the market, if the trends continue, it seems like your thoughts are that the most vulnerable place in our economy is the over leveraging or potentially lack of dollars. We have a constrained dollar supply, combined with we have debt that's out of control, deficit that's out of control, all on top of a dollar that's weakening. We can mention the third D. And that is leading to a situation where we're coming to a fork in the road. It's like, which happens first? Does a bank crack? Does the foundation of a lending system start to falter and then we have to step in? Or do we precede it and step in with something like QE to keep something from like that happening and inflate our monetary base? It seems like those are the two options.
Yeah, I mean, there are a number of risks. It's hard to say that this kind of shortage of liquidity is the major risk. It is the one that is like popped up recently, that like wasn't on my radar 2 weeks ago, but I mean, it's something I always watch, but there were no signs of stress. But I was warning with the TGA rebuilding the government's checking account, you just kind of how mechanically that works. You have to reduce liquidity because the RRP, the reverse repo, the bucket of excess dollars is gone. It was pretty straightforward that this is going to strain liquidity conditions. Now, whether or not it causes a crisis is a different story. In purple, by the way, this is the regional bank ETF, and you can see that when it reached 13% here, it was just a couple weeks later that KRE fell 21% on a week over week basis. Liquidity conditions are certainly tight. I would say that's a major risk. But yeah, look, the answer to any problem, whether it's, for example, if we go into a recession, a lot of people talking about that with NFP. That was your question. I'm sorry. The data, right, with non-farm payrolls, the huge revisions. A lot of people are talking about recession. Well, a recession would take our deficit to 15, maybe even higher. If you have rates going up in the face of that, like emerging markets do, then you're talking about 20% deficit, 25% deficit. It all depends on how the bond market responds. But in emerging markets, rates go up in a recession. Well, the response to that, you know what the response to 15% deficit is? We'll print the bank reserves because we're the Fed, and we'll use those bank reserves to buy all the debt if we have to. We'll do yield curve control to keep rates, rates start to go up, especially in a violent way. We'll just do yield curve control, buy all the debt, keep the rate wherever we want it. The answer is always for them. The answer for them, for the institutions like the Fed, the answer for them is to always print money and ease financial conditions. So I think I'd mentioned it in our first talk, but like I really keep coming back to the antidote, the way to protect yourself, or at least myself, that I see at least, is scarcity. When you are living in an overabundance of currency units, dollars, the antidote to that is scarcity. And, there's a number of scarce items, gold, Bitcoin, housing are the ones that come to mind. Although I do think that, to some degree, stocks might do okay, probably in gold terms, like S&P 500 over gold. It's probably going to go down from here. So in real inflation adjusted terms, like to answer your question, by the way, this is a chart that I always like to show, which is regarding the CPI and how accurate it is, right, with measuring inflation. So a lot of people don't know this, but CPI is actually an index. This is the index. It's a cumulative index, right? So this shows the cumulative change of prices. Well, we know that inflation is a monetary phenomenon, first and foremost. There are supply shocks and cost push that occurs sometimes. But if you look at CPI relative to M2, you can see that, I'll do it this way. You can see US M2 divided by CPI. This tells you the degree to which the money supply has grown faster than the official inflation rate. That is what this is telling you when you take the money supply and divide it by CPI. And what you can see is that since 1959, the money supply has outpaced that inflation index that we were just looking at by 600%.
Holy cow.
And if you look just, I got my first job kind of as Lehman was, or I was doing my interview kind of like a month after Lehman failed. So if you just calculate that from 2008 onward, it's 76%. The degree to which it's undercounted already, right? Because CPI is counting inflation to some degree. This is the degree to which the money supply is expanding above and beyond the official inflation rate. Since 2008, 76%. So yeah,
so when you talk about the numbers via the CPI index maybe not being an accurate representation of true inflation, this would be the graph.
Yeah, there's a number of graphs, and it's very painful when you look at housing affordability. So you relative to income, right? But the real purchasing power of that income relative to home prices, if memory serves, since 2008, the home price has outpaced the real purchasing power of the average hourly wage by 200%. I have that chart.
We're gonna have to have another episode specific. Comment below if you want Robert to come on, talk housing affordability. We can say 100% locked on that. More graphs, more knowledge. Rob, I'm sure 80% of the people listening caught about 50% of everything that you said, and maybe this will be a rewatch. I highly recommend listening with video in front of you so you can see what you're going through. But Rob, you're doing something that I see more and more people leaning into, is this nonprofit focused people first creation. Like you're really just filling a gap in the social media space, or at least, YouTube, I guess, is not really social media, whatever, the content space of having all of this knowledge and being able to disseminate it and show it in a way that isn't political, it's not emotional, and it's not as confusing. You see all these numbers thrown around in headlines and you're just told it's one way or another. The blue will say, oh, it's terrible. And when they're elected, they'll say it's great. And red will do the exact opposite the same way. Versus what are the actual numbers? What historically can we look back on to give us maybe some foresight as to what could happen? Has this conundrum ever happened before in this way? Okay, we can look at 1979. I love that. And for anybody looking to follow you, it's YouTube, correct, as our main source, and then X as well?
Yeah, so YouTube, it's Infranomics, INFRA nomics. And then on Twitter, it is at INFRAA_. And I guess I'm big enough to have imposters, so just make sure it has the blue check mark.
Bots are a sign
so you don't get
success, as
scammed.
annoying
Yeah.
as they are. Yeah.
Yeah, but yeah, I look, I didn't know that it would take off like it did. My goal, of course, this can be a career, right? Like I'm learning that there is money to be made here, but like I really truly got into it with the sole intention of educating people on some of these very I've spent so many hours researching this stuff over the past 5-6 years. I've spent like tens of thousands, like 25,000 hours between macro podcasts and charting on TradingView and Fred, and like reading academic papers, and like I've been obsessive about it. But I thought to myself at the end of that, right, where I kind of was like, okay, I get it. At the end of that, I was like, people shouldn't have to do that to understand their financial system, to understand economics. Like, shouldn't have to do that. There should be someone that tries to explain to the average person. And so so that is my sole focus, is to provide that education and provide value If people find it valuable. If they don't, that's okay too. You know, if people disagree with me or don't like my method or ways of going about that, that's totally fine. Like, this is just a thing that I'm trying to provide for those
Which
that
is
want it.
another great reason why you should have your platform. It's not about being right or wrong. It's about finding truth. It's about finding reality, and your ego is detached from it in that way. And I think that's something that's very rare in the social media space, of having you being right, not being wrong, as the number one reason you're creating it, which I think a lot of creators do. Not all, but a lot do. I think people are more tired of it than they aren't, and that's leading people towards channels like yours. I'm a subscriber. I text you when I watch the videos. You know that. But guys, comment if you want Robert back on. I got a bunch of people that said we needed him last time. So housing affordability next time. But for right now, Rob, I would say that this next month or so is going to be very telling in the bond market.
Yeah, I think the things for people to watch for the next month is the price of gold, because I will remind people that this is a very simple concept, very misunderstood. When you look at the price of gold, that is gold denominated in dollars. Well, when you invert it, if you think of it like a foreign exchange, a foreign currency cross, that is dollars denominated in gold. So next time you see a gold chart, invert it and realize that that is what the market is pricing in for the purchasing power of a dollar. And it's a waterfall. So I would say watch gold and watch the 30-year yield.
Gold and 30-year. Awesome. Rob, appreciate you as always, brother. We're going to bring you back on. Keep rocking and keep rocking on the YouTube, all right?
Appreciate it.
Sweet.